Howdy, Jacob here. Today we're looking at PetMed Express. Okay, so 13% dividend yield, very substantial. We see that the market cap is 110 million, enterprise value 56 million. I will say I've actually looked at this company fairly recently and have noticed that they haven't reported their Q3 earnings yet, and they have been filed. Um, they haven't filed with SEC yet, and so the Nasdaq has told them that they're against compliance. They've said that they haven't come out with a date to report that yet, but they also have to reconcile previous financial statements, and so that worries me some. That they did say that all the cash from their balance sheet is accurate and everything, but I'm worried about the income statement and the free cash flow statement, as those are my main sources of free cash flow and earnings calculations. And so before I go into it, I want to say that I would want to see those reconciled reports before doing any before investing at all into this company, even if I think that even if I get to earnings and cash flow estimates that are screaming deals. So please keep that in mind. And again, not financial advice, just some rando on YouTube uh, advice. But um, yeah, be careful with that if you want. I just saying that I would definitely be careful when companies come out and say, "Hey, the last couple of years, we're going to have to redo some statements and um, yeah, we're not. That just does not sit well with me. So, first things, let's go over 110 million market cap on 56 million enterprise value. They're similar to Chewy, where they really like sell everything dog, cat, pet related. Um, and then, I mean, it looks like a fantastic business when you get rid of the last 2 years. You see that 233 up to 309, so not a lot of growth, but still a good amount of growth. Margins down a little bit, but not too concerning. Return on invested capital, absolutely amazing. But then you look more recently and you see that margins are absolutely just hit hard. They have a dividend that they can't afford with earnings per share. Let's see on the cash flow side and the balance sheet side, but that's fairly concerning. And then again, return on invested capital is going to be low because their earnings per share is low. So on the income statement, let's see total operating expenses. Yeah, it's just their sales. Their sales have cost of sales, general and admin has increased much more substantially than their gross profit and everything. Um, Income tax low because they didn't earn anything, so that's why. Balance sheet extremely healthy. So 104 million cash on hand with no long-term debt and no short-term debt. So interest bearing from that perspective, free with 104 million cash on hand. That's a very positive sign if that's correct. From a free cash flow perspective, they're paying out 25 million in dividends, and that is more than what they can afford in the rolling 12 and in 2023 and in 2022. So it looks like they're just digging into their cash position to fund those items, which is not the best use, is not a healthy thing. You can't be doing that forever, is what I mean by that. It's not saying it's unhealthy for a cyclical business to dig into cash reserves to fund a dividend, but for doesn't look like this is a cyclical thing. It uh, looks like something else. So to me, I'm a little bit concerned, definitely with this dividend payment, and I'm absolutely concerned with them having to reconcile things. So keep that in mind when I make these assumptions. I might be a little bit more cautious than if I were to have just seen these numbers, because I do know that in the background they are reconciling information, which makes me skeptical that these are entirely and fully accurate. So revenue side, I mean, the last 2 years they've just been absolutely hit, but they're actually up from 2023 to rolling 12. So that's interesting to see. I would not be surprised if it was a no growth business over the next 7 years. I'm going to do a pretty wide range of um, wide range on the margin side, and then the dividend, I'm going to cut it probably by 2/3, because if that's an 8 to 9 million payout, that seems a lot more reasonable to give the company opportunities to buy back shares that are possibly cheap as heck, and then make acquisitions that make sense for the company. And so if I do that, what do we do? We get to a price needs to fall 23% before we get a 15% return given these assumptions. I think I'm being conservative here, so I could easily see this being a buy for different people, but for me, and hopefully for you, you take into consideration and possibly wait a little bit until they actually come out with these reconciliation statements on both income and for cash flow and balance sheet, basically everything. You just want to see what those numbers actually are. And if these numbers are accurate, I mean, again, I'm being very conservative here. And so if I were to assume that it'd be closer to history and on both the revenue change, the margin side, and the dividend side, I mean, you could be looking at a fantastic buy right here. But again, please do your own research. I think at least right now with reconciliation reports not out yet, it's definitely risky. But once those come out, if everything seems to be reliable, then um, it could be a fantastic opportunity at this price. So thank you, and hope you enjoyed the video.